If you want to know what's going to happen in the economy and the financial markets, I'll give you everything you need to know right here today. I explained this in previous videos, but you're going to get the information that has happened right now, and that will give you insight as to what's going to happen in the future. The first thing, we're going to look at the Fed doing it. What are we talking about? Of course, increasing interest rates yet again. The second thing is, what is the impact of that? And the third is, what will happen to stocks, your 401ks, your retirement accounts, all of this today. Let's go. If you stick with me throughout this video, I'm going to explain what you need to know right now today, and I'll give you all those details very simply, okay? November 2nd, you could see that the Federal Reserve issues this statement at 2 p.m. and it came out. The markets were a little bit iffy about it, but in general, it was seen as positive. Why was that the case? Well, number one, the 75 basis points or 0.75% was the most likely outcome. That brings the range of, at the top end, 4% on the Fed funds rate. Now, what the market did like was the highlighted portion. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. What is he saying here? When we increase interest rates, it doesn't have an impact tomorrow or the next week. It takes time. Therefore, we expect that what we've done previously is going to start to ripple through the economy and the financial markets at a later date. And essentially signaling, without saying so in this many words, is that we're going to start to soften up. If you watched yesterday's video, I told you that the Federal Reserve was likely to increase by 75 basis points and that they would try to give the message out there without specifically saying it, that they were going to start to ease up at a later date. Now, they didn't put their finger on it necessarily, but that the conversation would come up at the following meeting. In 1 month from now, people need to realize this, 1 month from now, the Federal Reserve is going to increase interest rates again. And if they go for a 50 basis point hike this time, that brings the Fed funds rate to 4.5%. Look at where we were at the beginning of the year. This is huge. Look here, you could see that the Fed approves a 0.75 point hike to take rates to the highest since 2008 and hints at change in policy ahead. This was the big article with this title here because they really wanted this. And this was the top article on CNBC saying, oh, there's a change in policy ahead. But there were so many more important things that Jerome Powell had said throughout the question and answer portion. You see, at 2 p.m., the statement is issued on their website. And then at 2:30 p.m., you have the chairman that comes out in front of everybody and first reads through the script and then takes question and answers. And during that period, we get more nuance. We get more information than what the statement had to say, though he often does refer to the statement, or he has a piece of paper always with him that he wants to reference to make sure he says it exactly word for word. Jerome Powell says he sees daylight, but it's at the end of a longer tunnel. The Fed chair stated that interest rates will go up more than projected and that the path there could involve smaller hikes. Now, he didn't say that, okay? Let's be very clear. But that's what this article here is suggesting. Why did they say that? Well, partially what I discussed a moment ago was the fact that they kind of made it seem like they're not going to be as strong. But there was in no sense of the wording at all telling us that smaller hikes would be coming. We're just expecting that to occur based on the language and Fed speak that they love to use. Here are a couple quotes. The ultimate level of interest rates will be higher than previously expected, and it would be appropriate to slow the pace of the increases as soon as the next meeting or the one after that. You see how that part isn't in quotes exactly? Because he didn't necessarily say that. But anyway, I digress. Let's move on. Powell emphasized no decision has been made on the course ahead, and there's still some ways to go. That did not sit well with investors, let me tell you. I think it is very important for all to see what's been happening over the last little while and, of course, what impact this has. All throughout this period, we have been told the Fed's going to pivot, the Fed's going to pivot, the Fed's going to pivot. And all the way down the line, all throughout 2022, you saw it for yourself. Everybody in the financial markets, you got the Jim Cramers and all the other mouthpieces on CNBC saying the Fed's going to pivot, the Fed's going to pivot. Don't worry, don't worry. As soon as markets come down by 10%, the Federal Reserve is going to come in. And they didn't. And here we are over and over and over again. And I said that the Federal Reserve is going through a cycle. And during this cycle, you will experience higher interest rates. At what rate they stop at, I have no idea. My crystal ball is non-functional, okay? You can ask, Jim Cramer, maybe he knows. But what's important here is that all the way down the line to the YouTube influencers, they were telling people the Federal Reserve is not going to increase interest rates. And this is very terrible that they pushed people to believe it even now today. At what point are we going to come to grips with reality in the situation that we are in? We must stand up and say, this is unacceptable to be told this information repeatedly over and over and over again from each and every level. And nobody's waking up to the fact that, hey, we're already in a month from now at 4.5% on the Fed funds rate. We must understand how devastating this is. Now, I could go on a rant all day, but let me show you this. The expectation was that this pivot was going to come, and yet markets had been generally heading lower all throughout this period. And now the expectation is that the Fed funds rate is going to end up over 5% before they bring that down. Because if you're going to get a 50 basis point in December, that brings it to 4.5% on the top end. And then you might get a 25 basis point later on, and maybe another one at the next meeting following that. And there we are, we're in that 5% range. I don't know where it's going to end up, but ultimately, if inflation is still high, even on their numbers, they do not have any excuse. In fact, when you look at the data itself, breaking it down, this is several pieces of data, but you look at what's happening with real estate, you look at industrial data, you look at labor market, whatever, all these different things are basically showing that they started to do a little bit better here. And that is not a good thing if you're the Federal Reserve or if you're an investor and you're hoping that the Federal Reserve is going to have an excuse to start to slow back on that. It's not happening. We see that, okay? Very clearly, the market is in a position, and Powell mentioned that in today's conference, that the labor market is in a position where, they can afford, essentially what he tried to say was, they can afford to have a higher unemployment rate, but because there's so many jobs that are open, that probably won't be the case. I don't know, but you can agree with the fact that there are literally millions and millions of job openings right now near a historic high. So that is something to think about in the direction of the Federal Reserve. Here is one very good example of the way that the articles are written, analysts talk about it, everyone in between, that they are upset about what the Federal Reserve is doing. And I understand that I received a lot of hatred and a lot of individuals that are not happy with me right now because of the direction that happened, okay? And I'm just taking that, I'm the punching bag. I got it. In the world's financial markets, the U.S. Federal Reserve Chair Jay Powell increasingly cast in the role of playground bully. This is ridiculous. Anyway, booming over the prostrate form of the global economy, chanting, hike, 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 with malicious glee. This is the type of attitude that these people have, that increasing interest rates and trying to have a little bit of responsibility is bad. No, not at all. Not at all. But that's the world we live in today, okay? I just wanted to bring that to you just to give a little insight as to the way it works. I see articles like this all the time. I see the financial analysts talking about this same thing over and over and over. Stocks stumble after Fed signals rate hikes are here to stay. Wow. Did they think the pivot was coming already? My goodness. My goodness. In the second paragraph, it's kind of connected with that. And you could see here, giving the economy a bit of a breather from punishing interest rates was what they were hoping for. Punishing interest rates? Really? Come on. You've had, since the financial crisis time frame, you've had super low interest rates. And now, for once, interest rates are getting to a more reasonable level and it's punishment? This is the world we live in, okay? We need to just repeat that over and over again. Just as the risks of overdoing it are immense, underdoing the policy response to inflation could also come with grave consequences. If central banks fail to bring price increases back under control quickly, businesses and consumers may come to expect permanently higher inflation. Workers could factor that into their wage negotiations, businesses into their pricing decisions. Inflation could begin to fuel itself. This is the entrenchment of inflation and the big concern. In fact, Powell was asked this question, and he did his job of sidestepping that as best he could. But it's important to understand that, yes, in fact, inflation is entrenched because the consumer believes that they're going to be paying a higher price into next year. They realize this now. They look at the gasoline, they look at their housing prices and rent, and every component. It's all going up to one degree or another. Yes, we've seen some commodities go sky high and come back down, but in general, as a cost of living analysis, things have been moving up. I think it is quite apparent, to say the least. Okay, look here. The stock markets. I've been talking about this a long time and people didn't like it. But guess what? You're here this far into the video, so you are here for the truth. Let me unveil that for you. Meta, Apple, Amazon, Microsoft, Google, as a percentage of the total S&P 500 market cap, has declined considerably from its peak right around that range of 2020 into 2021, when things were going just nonsense, bizarre world levels. But one that stands out is Apple. I mean, it's in ridiculous territory, to say the least. All of the growth of the energy sector has been nothing in comparison to Apple. Apple has been, it's certainly off its high, but when you compare it to the entire energy sector, it is valued much more, $500 billion more, in fact. Comparing these two, it just shows you how ridiculous this one company is. Is it really? I understand iPhones, iPads, I understand. Extremely valuable company in many ways. And you just compare it to the entire energy sector, and things are kind of weird about that. You let me know what you think in the comments below. We have this to finish the video before I give you the breakdown at the end, so stick with me. As housing costs soar, co-living makes a comeback. Okay, so if you want to read the article, links in the description under the sources. But what I'm trying to tell you here is that time and time again, you create a system in which there's all this easy money. And then you go through that cycle and you create that punishment that they talk about. And of course, it's going to have an impact on regular, everyday people because they're so used to the easy money. They were borrowing so cheap and businesses were borrowing and everything was so fine until it isn't. And that's the problem that we have today. While I'm no Britney Spears, I can tell you that, oops, the Fed did it again. This is important to note because everything is really surrounding what the Federal Reserve does and says on a daily basis. 75 basis point increase, or 0.75%, bringing the top end of the Fed funds rate to 4%. And like I said, in a month from now, we're going to be potentially at 4.5%. Quite significant when you think about what mortgage rates are going to look at. I mean, think about it. December 31st, mortgage rates, are they going to be over 8%? Quite significant. Jerome Powell signaled that rates will end up being higher than anticipated and will remain there for longer. So put that inside your brain. Remember that, okay? Markets love the statement which suggested that future rate hikes would not be 75 basis points. That's kind of the terminology that was being used there. Risk assets have performed poorly now and historically when interest rates rise. Remember this, risk assets. And that could be something like stocks, could be something else when you look at it, but those risk assets are always going to be the ones that go first. The riskiest of that bunch go first. You understand? The riskier it is, or seen as risky, then of course that takes a big hit. We did see that very clearly. Watch the balance sheet of the Fed and other central banks very carefully to determine the direction of the stock market. That's what you need to do. The balance sheet, I cover it here on this channel very regularly. If you want to stay on top of that each and every day, all the news you need right there, hit that subscribe button. I'm going to bring you the latest and greatest. Nobody brings the depth of the central bankers and what they do like this channel does. So hit that subscribe and I'll see you tomorrow.